Interest rates are double what they were a year ago, but you can get an interest rate that is 3% lower than current rates. Wait a minute, what did I just say? Stick around and I'll tell you 3 secrets of the mortgage industry. And I'm a lender too, you know. Hey everyone, so you'd like to buy a home or an investment property right now, but these high interest rates are holding you back? Well, I'm going to tell you what you can do to beat those high interest rates so you can get into the home of your dreams with some creative but simple financing options. My name is Stu Simone. I'm an associate real estate broker at eXp, the world's largest brokerage. And yes, a licensed mortgage loan originator, NMLS number 2246767. Go to stuartsimone.com for a free consultation where we will go over your particular situation and I'll get you pre-approved. All right, let's get down to it. Today we're going to talk about how to save money when buying real estate with something called a buy down. You know, when you borrow money from a bank to buy a house, you have to pay back the money with that pesky little thing called interest. Well, right now those interest rates are double what they were a year ago, and it's making it harder to afford the home of your dreams or to purchase an investment property sure to cash flow. The good news is that the higher interest rates have kept home prices from rising as fast as the inflation rate. And when we couple this with interest rate buy downs, now that home that cost so much a year ago might actually be more affordable now. A buy down is a special way to make your interest rate lower, at least for a little while. There are several different types of buy downs, but we're going to talk about 3 of the most important ones for real estate buyers. The first one is a temporary rate buy down, and it's most commonly referred to as a 3-2-1. The great news for you, the buyer, is that with temporary rate buy downs, the seller or the builder, if you're buying new construction, often will pay the fees associated with this buy down. With a 3-2-1 buy down, the interest rate is lowered by 3% in the first year, 2% in the second year, and 1% in the third year. Years 4 to 30, the loan will be adjusted to whatever the mortgage rate would have been today. This means that your monthly mortgage payments will be lower in the beginning, but they will go up a little bit in the second, third, and fourth years, and then they will get back to the regular rate for the rest of the loan term. The idea is that you can use that time to save money and then refinance your mortgage later to get a better interest rate. So, for example, if the interest rate would have been 6.5% today, with a 3-2-1 program, it would be 3.5% for the first year, 4.5% for the second year, 5.5% for the third year, and then 6.5% starting in year 4 for the remainder of the loan. Now, if you watched my prior video about the state of the economy and the housing market at the start of 2023, most experts are expecting rates to decrease, which means now is the perfect time to consider a buy down. By the way, there are variations on this loan, like a 1-0, 2-1, or 3-1 buy down. The good thing about temporary buy downs is they can make your mortgage payments monthly more affordable in the beginning. The downside for those planning on staying in the property is that nobody can guarantee that rates will be down around the time you want to refinance. So the bottom line is for this is undoubtedly a loan product to consider if you're planning on keeping the property for only a short time. Now, the second type of buy down is called a permanent interest rate buy down, which is when the interest rate is lowered permanently. You've probably heard the term discount points, but might not be sure what that means. Discount points, also referred to as mortgage points or prepaid interest points, are a one-time fee paid up front. Each point that the borrower pays is usually equivalent to 1% of the loan amount. So if the interest rate is, say, 6.2%, you can pay an extra 1% of the purchase price towards your loan and lower your interest rate down to, say, 5.2% for the remaining 15 or 30 years of the loan. By the way, you may have heard of the term basis points. 1 basis point equals 1/100% or 0.01%, so 100 basis points equals 1%. Now, costs vary with permanent rate buy downs, but typically expect to pay about 1% of the home purchase price up front to get this interest rate buy down. If you are a buyer who has enough for a 20% down payment with money left over and you plan on keeping the property for a long time, this is a great strategy for you. You're now paying 21% up front, but you'll pay less every month for the life of the loan. If you need to decide between making a 20% down payment and buying points, make sure that you run the numbers, as a lower down payment could mean also paying for private mortgage insurance, or PMI, which could cancel out the benefit of buying the points for a lower interest rate. So run those numbers. Buying points to lower your monthly mortgage payments may make sense if you select a fixed rate mortgage and plan on owning the property after reaching the break-even period, which is the time it takes to recoup the cost of buying the points. Payments beyond your break-even point are where you really start saving. By the way, sellers may also offer to buy down a buyer's mortgage to incentivize the buyer to purchase their home. In these circumstances, the seller will make the one-time payment and deposit into the escrow account or pay for points over the entire loan term as part of seller concessions. Of course, this probably won't happen in a seller's market. Bottom line, if you are purchasing your dream home and picture yourself living there forever, you should definitely consider paying discount points. The third way to chop down that interest rate is with the adjustable rate mortgage, or an ARM. Please don't freak out and say that's what caused the 2008 crash, as many believe. Let me explain. The situation back then was that anyone who could fog a mirror could get a mortgage loan. Stated income loans were common, where people would just say they made a certain amount of money, and lenders just took them at their word and gave them the loan, which was often an adjustable rate mortgage. And the lenders then never explained how ARMs work, and that the rates could and would rise after the first year. Plus, many of those ARMs had balloon payments, which set the borrowers up to fail. What you want to look for now is a 552 ARM without balloon payments. A 552 ARM can give you a rate 2 to 3% lower than a typical fixed rate mortgage for the first 5 years. At year 5, it will adjust up by a maximum of 2%. So, for example, rates are about 6% today. You can get a 4% mortgage for 5 years. At year 5, it will likely adjust to 6%. So over 10 years, you'll have a blended average of a 5% rate. Again, you can refinance into a lower fixed rate, typically after the first 3 years, but that's assuming the overall market rates do not rise from their current levels. So, for example, on a $600,000 purchase, you would pay about $2,300 in principal and interest for the first 5 years. For years 6 to 10, you'd pay just under $2,900. And on average, that'd be $2,600 per month over 10 years. So the 5.5 ARM gives you 5 years in between adjustments, which allows for more breathing room in your budget for monthly payment exchanges than a 5.1 ARM, which adjusts every year. Now, here are a couple of ARM terms you should know. Margin is a set number of percentage points added to the index to determine your rate after the fixed rate period expires. Rate adjustments are tied to a benchmark called an index, such as the 1-year Constant Maturity Treasury Index, or CMT. Period adjustment caps determine the maximum your rate can adjust to at an adjustment time. For example, a 5.5 ARM with a start rate of 5% and a 2% adjustment cap means your rate won't be higher than 7% after the first 5-year mark. Lifetime rate adjustment maximum. ARMs commonly feature a lifetime rate adjustment maximum of 5 percentage points. Both 5.5 ARMs and 5.1 ARMs have a lifetime rate adjustment caps based on payoff schedules of 30 years. Now, similar to the temporary rate buy down, if you're not applying, similar to the temporary rate buy down, similar to the temporary rate buy down, if you are not planning on keeping the property for more than 5 years, this can be a great strategy. So people on the move and optimists tend to love this loan product. Okay, people, that's a quick rundown of 3 different ways to get an adjustable rate, 3% lower than the average market rate right now, and how those methods can help you buy more house than you thought you could. So hit me up if you want to learn more about buy downs, and while we're at it, let's get you pre-approved so you'll be ready to trade up with a buy down. Hope you enjoyed this video. Stick around here on the Rock Real Estate channel, Stu Simone Real Estate, and I'd love to talk to you soon about getting you pre-approved with a buy down or not. Hope to talk to you soon.